Well, bulls got completely run over on Friday and about the worst price action that you could have gotten. Unfortunately, the framework I was using didn't point in the right direction. We're going to walk through why. Yesterday, coming into this, I had hopes still that there was some risk appetite lingering and kept the green light on after I put it there on Monday following the breakout. And bond market and dollar signals, the relationships held, but the direction didn't go the way I wanted it and didn't go the way I think most wanted it to today. So let's start with the levels firstly. It was 2 weeks ago exactly that I proposed the question, how high could stocks go once they found the floor? It was 2 weeks ago that I dropped the red light on stocks looking for support, and we did find it. And the answer I came up with on the chart for the S&P 500 was basically the election gap. I kept talking about that on repeat. Now, on Monday, when we saw the run into that $5,800 level, I was hoping that we had enough momentum then to find more room to the upside into that gap. But what happened is instead we got rejected exactly at the gap. So the framework coming into this was that you needed to get back to 5,800 in the S&P to kind of reset the political expectations, the Trump premium that then went the other way. So that part I did get right. We did come back and we touched that 5,800 on the SPX. That's basically then where we unwound. The hope was that we could carve into that gap and then potentially set up room for upside. With the rejection happening then today, precisely at that level, that tells you the market has pretty deep conviction right now that there is either an overhead of uncertainty surrounding the tariff stuff that people can't figure out, or, and this is the more actually concerning one, not so much the recession argument, I don't think yet, but that tech is just a massively still over-levered position in most portfolios that people have to dump. And here's why I say that still is the simplest explanation, is because even though we had a macro narrative this morning around consumer spending and the inflation print and pressure for prices still too high relative to what the Fed wants, and then the sentiment, inflation expectations, they still sold tech more than anything. Companies that for the most part are resilient as far as tariffs go. That tells you that there is still a liquidation happening in the market, that there wasn't enough downside carved out on the way here through tech, which brought us here. And that brings a deep concern because that starts to look like a type of deleveraging style .com. Now, we don't have to go there quite yet. The price action here, I still think determines a yellow light and not a red one, because a few things did work. Namely were the relationships. The relationships held this week. That was the saving grace, where even though I had the green light on stocks, all the relationships I talked about still held up. Bonds rallied like crazy in the morning. That was the first sign. Folks have got to get used to bond rallies right now, signaling negative moves for stocks. The other thing is the way the dollar also dropped hard again. Dollar correlating to stocks to the downside. And that's where I was thrown in the last 2 days, because the message from the dollar and bonds were very positive. We had yields moving higher. And if you look at the trajectory of, say, Tesla versus yields, look at the way they've been connected. Yields were pushing higher and Tesla was too. And that was the false signal. So today the gap closed by way of the bond market rallying big. And that was the tell this morning, because the data didn't look too bad. The fact that Treasury buyers stormed back into the market tells you we're still dealing with the potential for that style of growth slowdown narrative. Now, here's where it gets a little bit more tricky though. There's one asset that actually held on decent, even though it's down more than stocks, and that's Bitcoin. The chart then for BTC, you have to watch very closely, because when you've got big tech selling off 4% and Bitcoin down 4%, that tells me that there is still room to give in the crypto markets over the weekend, as we saw S&P futures selling even past the close. So you've got to be careful in cryptos here. I think the crypto bulls are hoping the administration is going to give them something to bail them out from this risk-off move. But if stocks are indeed shifting low and risk assets are as well, the BTC looks still way overpriced. And it does bring up an interesting trade situation. If you do think there's going to be continued risk off, a short Bitcoin or short crypto versus a long stock position is the type of thing that might give you a hedge, since crypto markets are going to be open throughout the weekend. I'll see you Monday. Hopefully something stabilizes. Have a good weekend.